Hello, YouTubers. Thank you for following Aviva Spectrum, and I am your host, Sonia Luna, CPA. I'll talk about cannabis equipment, and I'll go through a very rigorous calculation for a retailer that's looking to either determine buying by borrowing money, the point-of-sale system equipment. This is the scanners, the displays, the registers themselves, all that good stuff that goes with a point of sale system, the equipment, and then I'm going to go through a leasing option and how to compare the two different types of options that you have. Equipment costs, let's assume that it's $25K, and in order for you to get it to its intended use, you will need $5K to get it up and running, not only training, but just getting wires and all that good stuff hooked up. So when you capitalize everything, your accountant's going to say, hey, you get to capitalize that installation cost. You are now capitalizing an asset for 30 grand on your books. Let's assume that both the debt and the lease is going to be for 3 years. Your corporate rate, because you were smart, you ended up being a C corporation for your retail business. You're at a corporate federal tax rate at 21%. The effective tax rate, because of 280E and other shitty things that come along with it, is 60% because you can't deduct pretty much anything that's after cost of goods sold. Let's assume this equipment at the end of either the lease or the note, it's got a salvage value if some sucker wants to buy it for $3,750. Let's look at some other overviews. If you're going to borrow to buy the equipment, you're going to borrow 30 grand because you know it needs to be installed and you need that extra 5K for capital in order to get someone to get that stuff working. So the interest rate they're willing to give you is 10.5. If you were allowed to deduct this equipment, which you're not on your federal tax return, you would have had an after-tax rate effect of 4.2% of this debt interest, okay, but you don't, okay, because it's a really crappy time to be in the cannabis industry for taxes. All right, term loan, you would get a 3-year term loan. The salvage value is the same amount that I mentioned earlier. You still have to maintain that sucker every 3 years, or once every 3 years, paying $300 at the beginning of the year. Say that 10 times faster. And the lease, let's assume the leasing company refurbishes this type of equipment, and that's their business model. They take the equipment, they do some updates, but then they lease it again to another retailer. The term there is 3 years. The payments would be annually totaling $6,667. The monthly payments are $556. There are no other expenses with the lease, like a service fee or what have you, but let's just assume that's the $556 is everything. There is no bargain purchase option, which is meaning the leaseor will let you buy it off of them for like a penny or $1, okay? It's not like buy one, get one. It's just super bargain at a penny or $1, something ridiculously tiny. Salvage value is the same as what it would be the equipment for the borrowing. That's just to notate what is the salvage value if you were to have a bargain purchase option, which you don't. Now, let's assume the loan amount is here. This template, by the way, is an easy Microsoft template. It's called the loan amortization template. You can plug in the numbers that I have. What I did is I summarized by year 1, 2, 3, what the beginning balance was, what were the total payments, the interest portion of the payments, principal payments of that 11K, and then the ending balance of the note. This comes up with a formula for you to say what your monthly payments are. It recalculates the number of payments and the interest expense related to this 30K note. Here's what's interesting. Get your accountant to show you the summary that I've done. So on the face of the note, they're going to tell you all your interest that you're going to be paying. Here's what I did. I just wanted to know the effective interest rate of this debt arrangement. So here I'm taking the principal, 30 grand, over the total interest I pay over the 36 months, and I just divide it. Interest divided by the principal, and I get 17%. See, there's a huge difference between 10.5 and the real interest on that dollar, right? On that 30 grand. Let's look at the buy option summary. So here's the pro forma. What we're doing here on the income statement is we're trying to get to what the true cash flow is. Cash actually going out, okay? So on your income statement, you would have put maintenance of -300 and interest payments of 2,700, depreciation. I'm going by the summary of the depreciation based on a tax basis. Makers is a tax basis, so you'll see all of this is from a tax rate table you can get from the IRS. I'm taking that equipment cost, which includes that 5K of installation. And now what I'm doing is taking that supposed, net income effect, the total expenses. So US GAAP, I would have taken this as an expense, okay? Because of 280E, I'm not allowed to deduct these expenses, right? That equipment is for sales. It's not part of cost of goods sold. It's after the fact, right? So I took this times the 21% C Corp tax rate. And so for this buy option transaction, for year one, it's going to cost me $2,000. Year two, $3,000. And year three, it's $1,000 approximately. So that's my pro forma net income, okay, US GAAP. Now, when I look at net cash flow coming out, what I'm doing is taking this equipment and saying, well, wait a minute, depreciation is not a cash transaction. So I'm going to add that back because I'm taking my pro forma. You'll see down here why I'm doing that, because I'm taking these totals. And so really depreciation ends up being what? A zero, a wash, right? I put it in here just to reflect the depreciation. I took it out. My loan repayment is the debt portion, the principal portion of that debt, right? The loan value, the borrower gave me $30,000, so I can pay the equipment manufacturer for the $30,000, and let's assume they do the install too for the $5,000, okay? Cost of equipment, that's also a wash. So now the net cash flow is I'm taking this pro forma effect, right? And I'm taking the I'm backing out certain payments here, like the depreciation piece, and now I'm getting to net cash flow of 14K. And I'm doing it for year two, year three, and you can see I have a grand total over here. So now I'm using Excel as their formula items that they have here, and you'll see net present value of the rate, which is the borrowing rate at 10%. I'm taking the values here, these cash payment values here, and it's giving me the actual net present value of these payments, okay? The net present value is 33K. The fair market value, and this is what I do, I love just looking at the ticket price, because business owners understand when they look at a catalog, oh, that equipment was like $5,000. And then when you start telling them, well, the installation cost is something we need to add later, what they do remember is the equipment cost. So I put in the equipment cost without the installation, and I say, look, let's just look at what you're really buying. You're getting 25K of equipment, and then you've got your net present value of cash outflow of 33K. So you have a cannabis premium of 8K. Now let's look at a lease. Okay, so the lease, here's your GAAP pro forma, right? And I just copied what was in the summary tab of the overview. This is your lease payment. Your cash outcome, you're going to be putting that negative cash out. You're going to be paying somebody for payment, the maintenance of it. And now you're also going to, because you can't deduct it, I'm taking those payments and adding the tax 21% C Corp tax rate. So the net income impact is $8,000 here, and you'll see it's the same, right? Going across, because it's a flat, fee that they've got. Now, the net present value of the lease, okay, is $20,000. The fair market value of the equipment is 25K. So you got a discount on the lease if you got a lease like this. So now let's look at the net present value of if you were to lease versus buy, okay? If you lease it with these lease terms, right, it's $20,000. If you buy, the net present value of that cash outlay that you have to put out is 33. So you have an advantage of the leasing arrangements, even though it's an interest that they don't lease it for free. There's an interest rate on that, okay? And we're just using the borrowing rate right now as an interest rate. But the difference between the leasing component versus your debt, you have a leasing advantage of 12K. Do you see this? So most analysis, you should have your CPA or finance person that you know and trust to kind of run through these model and make sure they understand 280E. And if that item really is deductible, and some of it can only be like a small portion of it could be deductible. Let's say not all of that 25K equipment was for the display and the bud tenders. Let's assume 10K was for the inventory management part. You follow? So if that was just for inventory as it's coming in, for quality control as it's coming in and it's trying to validate things, okay, maybe a portion of that 10K can be part of cost of goods sold. So those are little tricks that you need to have a cannabis CPA. You can always reach us at info@avivaspectrum.com to get any more questions answered. You can get a free consultation with me. Go to just email me at info@avivaspectrum. Check out our YouTube videos. We keep adding these technical presentations with calculations often. So you really have to hit that subscribe button and please offer a like. I also want to say for everybody to please be safe and healthy and practice social distancing. I know this is a challenge for a lot of us, but it's really important in the business community to accept alternative hellos. So think of the Japanese, think of the elbows, think of the fist bump might be even better. I think we might go to that, but hugging and all of that, I think we're just going to have to wait until there's a vaccine. That's my opinion as well. I get questions asked of me of that as also. Take care and peace out.